one of the question you have is like, if you have a SOFR-linked loan, or if you are evaluating a SOFR-linked loan, then should you hedge or not hedge? And if you should you hedge with a cap or a IRS or what kind of structure which you can use? So let's have a look at that. So this is the master chart which we have, and this will give you a good idea of how to manage SOFR. So if you look at interest rate swap, so if you hedge for 1 year, your rate is 521, 2 years is 471. It's a inverted curve. Why? Because the expectation of SOFR is that it will come down. So it's an inverted curve. So let's say you have a 3-year loan and you are looking at 431. Should you lock it? In fact, the good part is, while your current SOFR is around 5%, you are able to freeze your SOFR at 431. So, and what is your risk? You are saving yourself from the fact that if SOFR moves to 6% or 5.5% tomorrow and remains there, you are protected from the same. You are benefiting by doing an IRS. But the risk is that if there is a rate cut, then you are stuck at 431. I think overall, I would say it is still better to hedge at least 50%. The question is whether you should hedge 100% or how much, but not hedging at all is not the right decision. So you should hedge, in our opinion, around 50% you should hedge. Now let's look at the other products. For 3 years, we have evaluated some other products which you can avail for managing your SOFR. One of the simple product is cap. Now cap, as the name suggests, it just caps your interest outgo on SOFR. So your cap strike is 4%, which means wherever the market goes, you don't have to pay more than 4%. So if you take a 4% cap, then it cannot come free, right? It is only a cap. There's no floor. So if market actually moves to 3%, 2%, 1%, you get the benefit of the rate cut, unlike IRS. So this is like a nice thing. It's an insurance at a 4%. So it will have a cost, and that cost is 80 basis points. So that will make your worst case rate, instead of 431, 480. 4 is the cap and 80 basis point is the cost which you are paying. But the advantage is, if tomorrow SOFR comes down to 2% or to 0 or whatever, 2% or 3%, your rate will also come down. Your 80 basis point will remain constant and your rates will come down to 280, 380, etc. Similarly, instead of buying a cap at 4%, you can buy little out of the money cap. So you said, okay, till 5% I am okay, beyond 5 not okay. And for that, I pay an insurance premium of 30 basis points. So 30 basis point is the cost which I am paying for having a cap at 5%. And you enjoy whatever the real SOFR is. So problem here will be that most of the time, initially at least, you will be paying 530 only, whereas your IRS is 430. This is the difference. So to some extent, IRS should be done because of the inverted curve. At least I personally think it will be a good play, because this 431 is likely to go up. That's what I feel. It was even lower last time when we had a webinar, and now it has already come to 430, and we think it will move towards 480 from here. So it's a good play in itself to hedge this. Similarly, you can take a cap at 6%. Now there is another product which is called a collar. How does a collar works? Collar is a combination of cap and floor. So you take a cap at 5%. That maximum I will pay is 5%, and I will not pay any cost, but I will take an obligation that if SOFR comes down below 3.5, I don't want to benefit. The moment you take that range, 5 max, 3.5 lowest, your cost will come down to 0. Like minimum rate is 3.5. Within range, you pay the market rate, and cap is 5%. This is a very, very common product which is used for SOFR management. Now, this is another one which we really like. It's called cap spread. So you take a cap at 4%, but instead of paying 80 basis point as cost, you say that I don't want a full protection, I want protection up to 6%, because I do not think more than 6% SOFR rate will sustain. So if it goes beyond 6, the risk is to your head. 4 to 6, you are protected. If the SOFR rate is between 4 and 6%, then your effective rate will be 4%. If you do that, then your cost comes down from 80 basis point to 65 basis point. And these are your effective rates.